Hey everybody, I hope you are having a wonderful day. Here we make investing in options and stocks simple. And let's not lose any more time, let's go straight to today's topic.
Today, I want to break down Bollinger Bands the right way. Not the version where people say price touched the band so it must reverse, because that's one of the fastest ways to lose money. In this video, I'm going to explain how the math behind Bollinger Bands actually works, why they're a good indicator, when price is more likely to change direction and when it's not, how to confirm reversals using RSI and Capitulatory Volume, and finally, 2 simple option strategies that Bollinger Bands really help with. By the end of this video, you'll understand how to use Bollinger Bands with logic and probability, not guessing. Let's start with the math, because if you don't understand the math, you'll misuse the indicator. Bollinger Bands are made up of 3 lines, a middle band, an upper band, and a lower band. Everything starts with the middle band. That middle line is usually a 20-period simple moving average. That just means you take the last 20 closing prices, add them together, and divide by 20. This gives you the market's short-term average price, basically where price has been clustering. Now comes the most important part, standard deviation. Standard deviation measures how far price typically moves away from that average. If price stays close to the average, standard deviation is small. If price starts making bigger swings, standard deviation increases. The upper Bollinger Band is calculated by taking the moving average and adding 2 times the standard deviation. The lower Bollinger Band is calculated by taking the moving average and subtracting 2 times the standard deviation. So the bands automatically expand when volatility increases, and they contract when volatility decreases. Nothing here is predicting the future. It's just math describing how price has been behaving. The reason Bollinger Bands work so well is because they're based on probability.
So, why 2? Because statistically, about 95% of price action should stay inside those bands under normal conditions. So when price pushes toward the edges, the market is stretched. Not broken, just stretched. This is where Bollinger Bands become powerful. When volatility is low, price stays close to the moving average. Standard deviation shrinks, the bands tighten. This is compression. Compression means energy is building, the market is coiling. When volatility increases, price starts swinging further from the average. Standard deviation increases, the bands expand. Expansion means release. So Bollinger Bands are not really about direction. They are about volatility cycles. Quiet markets lead to explosive moves. Explosive markets eventually cool off. That cycle repeats endlessly. The single most important thing to understand is this. Bollinger Bands tell you whether volatility is cheap or expensive. When bands are tight, volatility is cheap. Options premiums are usually lower. Breakouts from tight bands tend to move hard. When bands are wide, volatility is expensive. Options premiums are inflated. Moves tend to slow down or mean revert. Professionals trade volatility first, direction second. Beginners do the opposite. Let's address this clearly. Price touching the upper band does not mean price must fall. Price touching the lower band does not mean price must rise. In strong trends, price can remain near one band for a long time. This is called a band ride, and it happens because momentum overwhelms mean reversion. In an uptrend, buyers keep stepping in before price can pull back to the middle band. In a downtrend, sellers keep pressure on price. So if you short every upper band touch in an uptrend, you're fading strength. If you buy every lower band touch in a downtrend, you're catching falling knives. That's amateur behavior.
This is where RSI and volume come together with Bollinger Bands, and this is where most traders finally start seeing the full picture. RSI measures momentum, not price. When RSI is high, momentum is strong. When RSI is low, momentum is weak. So when price reaches the upper Bollinger Band and RSI is extremely high, that tells you buying pressure is stretched. Not that price has to reverse, but that the move is becoming harder to sustain. When price reaches the lower Bollinger Band and RSI is extremely low, that tells you selling pressure is stretched. Again, not an automatic bounce, but fatigue is building. And that word matters, fatigue. Stretch doesn't mean snap immediately. It means the market is using more energy to go the same distance. The strongest signals show up when RSI starts to diverge. Price makes a new high near the upper band, but RSI fails to make a new high. Or price makes a new low near the lower band, but RSI doesn't confirm it. That tells you momentum is no longer supporting price. Professionals don't ignore that. Now this is where capitulatory volume completes the setup. Capitulation is emotional exhaustion. It's not logical trading. It's panic, FOMO, or forced exits all happening at once. At the lower Bollinger Band, capitulatory volume usually looks like panic selling. Stops get hit, fear peaks, volume spikes aggressively. That spike tells you something important. The weakest sellers are being flushed out. Once they're gone, there's often no one left to sell aggressively. Selling pressure dries up, and price becomes free to revert back toward the mean, the middle Bollinger Band. At the upper Bollinger Band, capitulatory volume looks different, but the psychology is the same. Late buyers chase, FOMO kicks in, volume surges as emotion replaces patience.
Once that demand is absorbed, price struggles to push higher. Momentum slows, and the market often pauses or pulls back toward its average. This is why you never look at volume in isolation. You don't want average volume, you want abnormal volume at Bollinger Band extremes. That's how you spot emotional extremes instead of normal trading. Now let's connect all of this directly to the two option strategies. The first strategy is buying options during volatility expansion. When Bollinger Bands are tight, volatility is compressed. RSI is usually neutral. Volume is quiet. That tells you the market is coiled. When price breaks out of that compression, bands start expanding, RSI accelerates, and volume increases. That's volatility expansion. This is where buying calls, puts, or debit spreads make sense, because volatility is expanding, movement is increasing, and options premiums grow with that expansion. You're not guessing direction, you're trading the release of pressure. The second strategy is selling premium during volatility exhaustion. When Bollinger Bands are wide, volatility is elevated. Price is stretched toward an outer band. RSI shows exhaustion or divergence, and volume spikes emotionally. That combination tells you the move may be near completion. This is where selling credit spreads make sense. You're not trying to pick a top or bottom. You're letting time decay and volatility contraction work in your favor as price reverts back toward the middle band. So Bollinger Bands show you where price is stretched. RSI tells you whether momentum agrees. Volume tells you whether emotion has peaked. When all three line up, probability shifts. That's not prediction, that's structure. And that's how professionals use Bollinger Bands with options.
All right, that's it for today's video. If you made it this far, you now understand Bollinger Bands the way they're actually meant to be used. If this breakdown helped you, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss what's coming next.